For those of you who have not met me, Patrick Maloney, I'm the CEO of Litigation Capital Management. My background, training and qualifications is in the law. I was admitted to practice in Australia about 24 odd years ago. I came into the litigation funding industry quite early in its cycle. I came in as a private investor actually in this company back in 2002. The following year, in 2003, I was invited to come onto the board as a non-exec. But in a small company, my role as a non-exec was very hands-on. I was the only lawyer and the only litigator involved in the operations of the company and the only one on the board, as a consequence of which I was relied upon very heavily by the company in terms of making its investment decisions and managing those investments through to a conclusion. So I did that as a very hands-on non-exec for the next 10 years until 2013, when I shut down my litigation practice and I came across to manage the company on a full-time basis. I was set the task of preparing the company for a listing on the public markets in Australia. In 2016, we did an IPO on the Australian Securities Exchange. We traded then off the back of that and set about expanding the territories in which we operated. So at that stage, the business had predominantly provided funding in the Australian market and New Zealand market, a little bit up into Asia and some other territories, but the focus of the business was very much in that region. We set about expanding more up into Asia, and then ultimately with bringing Nick and his team on, we moved into the Northern Hemisphere, into the UK market and into Europe. With the introduction of Nick and bringing on he and his team, we delisted from the Australian exchange and we listed up here on the London exchange. And we've traded now in our original regions down in the Australasia area, up into Singapore, where we established a permanent office to fund into both Singapore and Hong Kong, and then Nick and his team up here in the UK, funding into Europe and down as far as the UAE. I might just pause there and get Nick to introduce himself.
Thanks, Patrick. My background is actually not that dissimilar to Patrick's. Trained as a lawyer, qualified in the early 90s, I think 91, 92. Practiced as a commercial litigator until 2010, when I left full-time practice and founded a funding business, went into litigation finance. I founded a firm called Van Capital. Went from Van to Burford, where I was until 2016. When I left Burford, I ran Burford globally outside of the US. Left Burford to concentrate on the work that I'd been doing at Burford, which was very much focusing on taking litigation finance from a single case funding product into a more broad-based corporate finance offering. I'd known Patrick for over 10 years. I'd financed cases with him when I was at Van. I'd done the same at Burford. And he expressed to me his intention to move LCM into the Northern Hemisphere. He expressed that he wanted to consider taking advantage of the UK AIM market and moving off the Australian Securities Exchange in Sydney. And the combination of that with what I'd learned about his underwriting processes and what he was doing, which we've probably come on to, but the unique way in which LCM deals with its underwriting. And bear in mind, I'd had the experience of Van, of Burford and of Chancery, so I knew a lot about the industry. I knew how underwriting worked, so I was impressed with what he was doing, the processes he put in place, the unique nature of it, and of course his track record. So he convinced me to roll my team from Chancery into LCM, and that's what we did in the end of December last year. So that's sort of the potted history of how we get to where we are today.
So LCM as a company commenced in the funding industry 21 years ago. LCM was one of the pioneers of starting this industry not only in Australia but globally. So there was 3 companies that really started this industry. We were one of them. IMF Bentham, which is a company listed on our Australian exchange and a very much smaller outfit, started this industry. It very much started out of insolvency practitioners needing a way to finance claims that were either inside the shell of the insolvent company or statutory rights that they might have against errant directors in respect of their conduct. It then emerged sort of into the early 2000s into a product that was used by impecunious claimants, so not just in the insolvency space, so it branched out from there. And in 2006, we had a decision of our High Court in Australia, which sort of mandated litigation finance as not being an abuse of the process of the court, and the industry very much spread out to the rest of the world after that decision was handed down by a high court. So LCM's continually provided litigation finance into the market since 1998 when it started. During that period of time, we've funded through to conclusion 206 odd investments. And respective win-losses, we've lost money in respect of only 10 of those investments over that entire 21-year period. And in respect of that 10, as a subset of that, only 5 of those cases were ultimately adjudicated against us in the court. And the reason why I bear that out as opposed to losing money in respect of 10, it's only been on 5 occasions that LCM has made the wrong judgment call in respect of that. So that bears out the rigorous nature of our underwriting and due diligence process. And in respect of the other 5, they may not necessarily, the ones we've lost money on, it may not necessarily be LCM's fault. There might have been a change in circumstances in respect of the target or the defendant, and matters beyond LCM's control. So LCM has built up over those 21 years methodologies and systems which enable us to accurately predict what the outcome of a dispute will be. And that's a dispute either being litigated before a court or through the arbitration process. In terms of financial metrics which are generated from the strategy that we employ, we've taken the last 8 years' track record as being most representative of what the company looks like moving forward. So if we go back beyond that 8-year period, we're very much operating in an emerging market. So the capital structure of LCM was very different, and its management was very different in terms of what we were doing. So in terms of that last 8 years, and this is inclusive of investments which we made which were unsuccessful during that period, we've generated an internal rate of return of 80% and a return on invested capital of 135%. And those buoyant financial metrics are really just a direct reflection of our ability to underwrite the risk associated with a piece of dispute or a piece of litigation, and accurately predict what the outcome is going to be and to manage that investment through to a profitable outcome. So in terms, briefly touching upon how LCM generates its revenue. So litigation finance involves a litigation funder providing a capital source to a funded party to enable them to pursue a dispute through to conclusion. We also provide a risk management tool in some jurisdictions in which we operate, which is providing a contractual indemnity against an adverse cost result. So what I mean by that is common law jurisdictions, typically the unsuccessful party to a piece of litigation or arbitration often is required to pay the successful party's fees. So as part of the package that we provide, it's capital to pay the solicitors, the barristers, the court fees, experts and the like, and we also provide this contractual indemnity in respect of an adverse cost result. In return for that, we generally get paid either a multiple of our invested capital upon successful result, or a percentage of the outcome. In other words, a percentage of the pool of capital that we generate through funding that dispute, and then we get our investment back on top of that. So that's, in very simple terms, what the revenue model is in respect of providing litigation finance. Now, LCM historically, and the entire market for that matter, of litigation finance was single case investments. And by that I mean that we would fund the resolution of a single dispute as opposed to a pool of disputes. So the characteristics of an investment like that are we provide the capital, we provide the risk management tool, and that investment has a binary outcome. We either win or we lose, or we negotiate a successful, profitable outcome or an unsuccessful, a loss-making. So very difficult end of the market is where we started. Very much binary outcomes. And the track record that LCM has been able to generate over that period of time has been running that model. So single case investments, win or lose, and what have you. Now more recently, with the introduction of Nick and his team, we have moved, we've expanded the products that we supply into the market into what's called corporate portfolio funding. Nick will talk in a bit more detail about this, but what we're seeing in the market now is very much a turning point in respect of who's using litigation finance as a tool. So historically, it was people who were using our product or our capital source through necessity. In other words, an insolvency practitioner or an impecunious claimant who had no choice but to use our funding in order to pursue their dispute. And what we're seeing now in the market is well-capitalised and sophisticated corporate clients using us to get the accounting benefits from using external source of capital to fund its disputes, to manage the risk associated with litigation, and also to bring our expertise into the whole process. So in order to manage disputes in a far more efficient manner than they would be able to otherwise, given our experience. So if I might touch upon the way LCM accounts for this. This is a relatively vexed issue in the funding market at present. LCM, since it started 21 years ago, has adopted a very, very conservative way of recording its financial performance, which is very much akin to cash accounting. So in respect of the investments that LCM makes, whether it be on a single case basis or a portfolio, that is recognised on our balance sheet as an intangible asset. So that investment and nothing else. And when we have a result and the cash comes in, that gets de-recognised. So an incredibly simple and very conservative way of accounting. Some of our listed peers have adopted fair value accounting and have come under some recent criticism for adopting that. In respect of LCM, we're very much committed to utter transparency in respect of what our balance sheet and P&L looks like. And as LCM's business grows over a period of time, there may be a point in the evolution of our business where the appropriate accounting principles for us would involve some fair value accounting. But we would do that alongside our cash accounting and make it utterly transparent for the market to see how we've generated our revenue and what it actually is, and what component of that comprises fair value and what component comprises cash. If I can look at LCM's performance over the last financial period, over the last 12 months. So it's important before we go to the actual financial performance and the numbers, just to recognise what LCM achieved during that 12-month period. So we achieved expansion into Asia with a permanent presence in the Singapore market. That permanent presence in the Singapore market was in reaction to legislative changes in both Hong Kong and Singapore, which allowed litigation finance into the international arbitration space in those jurisdictions. So we moved to open an office there to service more completely those emerging markets into Asia. We also integrated Nick and his team up here in London. So we've had a total integration of Nick and his team. We all use exactly the same underwriting methods. So risk associated with our investments is still centralised through head office in Sydney. We all use utterly the same systems and methodologies in respect of selecting investments to make. So we expanded into the London market, into the European market, and down as far as the UAE. So also during that 12-month period, we delisted off the Australian Securities Exchange and listed on the London market. So LCM went through a tremendous period of growth last year. And notwithstanding achieving all those things, we also managed to perform better than the market expected in terms of our profitability. So our gross revenue was up. There was a slight dip in terms of our statutory profit after tax, but simply associated with that tremendous period of expansion and us investing in the future of the company. These entire businesses are driven around the ability for us to attract and identify appropriate investments for us to make, whether they be in single case funding or whether they be in portfolio funding. During the 12-month period, and compared to the previous period, we increased our applications from 125 to 419, so exponential growth in the number of applications that we were able to generate. And to give investors a measure of how selective and how disciplined we were, notwithstanding going through unprecedented growth that year, our usual conversion rate in terms of applications across to funded matters ranges between sort of 3 and 7%. And by that I mean of the number of applications we receive, how many actually turn into investment. Now, that's typically somewhere between 3 and 7%. In that year of extraordinary growth last year, we brought that metric down to 3%. So what that should tell investors is that notwithstanding the other distractions which we were involved in during that period, the one thing that didn't suffer during that period was our ability to underwrite and undertake due diligence in respect of our investments in the same fashion that we would other than having those distractions around. I might pause and get Nick to talk about the evolution and the opportunity that we see in terms of the market for portfolio funding. So before Nick does that, LCM is very much leading this expansion into this market globally. In the past 6 months, we have set 2 of these corporate portfolio transactions. 2 might sound a relatively modest amount, but the first observation is it's 2 more than anyone else operating in our industry during that period. And the size of these transactions in comparison to our other portfolio of investments at any one time, we did one in the aviation space which comprised 38 separate disputes comprising that portfolio. And the other one was in the building and construction industry, which was a further 7 disputes. So describing it as 2 really doesn't give full credit for the size of those opportunities. And I might just hand over to Nick to talk about the evolution of that product.
So litigation funding historically has been single case funding where funding is taken out of necessity. So you have a situation where an impecunious claimant, either an office holder in an insolvency situation or simply a company that doesn't have the cash flow to be able to fund its dispute process, takes external capital, which invests in the litigation, pays legal fees for a return on success. Very simple, basic product. But that's litigation finance at its most basic. And whilst pretty much all of the litigation funding that goes on, certainly in the London market, is single case funding out of that situation, it's still a really tiny percentage of the number of disputes that there are available in the world. So when you're looking at what the scale might be and the potential for growth and what's the size and market penetration of litigation finance, and sticking to the UK for now, it's really tiny. And there are a lot of funders doing single case funding, and they're all doing the same thing with the same template product, but they're all going after the same sorts of cases. Now, the market isn't flooded in London as yet, but when you look at the metrics of what the market is doing in terms of litigation spend, in the UK last year, there are a number of different surveys, but the average of the combination of those is that there was around £40 billion spent in litigation in London, or in the UK last year. Of that, somewhere between 3 and 7%, depending on which survey you read, was funded. Now that says 2 things. Firstly, it suggests that litigation funding is nowhere near a market which is saturated, because there's still 93 to 97% of the market to go at. But the problem with that, of course, is that 93 or 97% of the market is well heeled, probably, but certainly corporate litigation, which is being paid for by the corporate on a monthly cash flow basis. Now, what that says to us, and one of the things we've done in looking at this market, is where can we get scale, where can we deploy more cash, and where is the opportunity? And the opportunity is in that space. But that space is corporate clients that are currently deciding we'll use our own cash and not somebody else's cash for the purposes of our litigation disputes. Now, on the one hand, you'd have to be crazy, put bluntly, as a well-heeled corporate to use litigation finance in a single case basis, because it's way too expensive. If you didn't have to use funding, which is the majority of the work that's done in the single case world, you wouldn't, because you couldn't justify as a director of a corporate entity using our money at a 3, 4, 5, 6, 700% return. It just wouldn't be justified. So what we had to do was to look carefully at what the funding industry was doing, look at the criticisms. We wanted to get into that area of the market where there's no penetration, but we had to change our model. And there are a number of reasons for that, the first one being price. But then we also looked at the criticisms of what the corporate world was saying about litigation funding. You're too expensive, obviously, the starting point. You don't provide a solution. You don't fund small cases. You don't fund defense cases. You don't fund declaratory cases. Frankly, we had to look at ourselves fairly carefully after that, after the amount of criticism. But the reality is, those corporate clients have a need. They need a solution to their annual budgetary spend problem. They want to ease the tension between the CFO and the general counsel when it comes to that annual discussion over what's my budget. In order to address that, we had to address the most fundamental point, which is price. Now, the price reflects the risk. The risk is binary outcome in a single case. To change the risk profile and to avoid potentially, almost effectively avoid any chance of capital loss, what we've done is we've taken a set of cases instead of single cases, underwrite them in exactly the same way using the same rigorous selection process and metrics, but come up with a methodology which allows us to say we cross-collateralize our investment across 3 or more cases. So if we lose the first case, we get it back on the second case. If we lose the second case, we get it back on the third case. That changes the risk profile. That allows us to price the risk and make it a more palatable risk for that corporate client. But there are other reasons why corporate clients would want to consider using external capital. I mean, the main reason being, of course, that to pay present day, monthly, out of cash as a corporate client for your legal spend is hugely corrosive in terms of your EBITDA. And if you're a business which is valued on a ratio or a multiple of your EBITDA, then clearly there's another issue there. But more importantly, even winning litigation. So you spend all this money, it affects your EBITDA, your profits go down, you're paying out for the litigation spend. Even when you win the claim, the money that comes back in is treated as an exceptional item and it's not booked as revenue. So even winning the case doesn't help you. So you've spent the money and then when you get it back, it still doesn't work. So from a corporate client perspective, there's a compelling financial and accounting reason to use other people's money, or our money, hopefully. But the reality is you have to then adapt your product, which is what we've been doing, to consider how we might deal with declaratory cases, smaller cases. Smaller cases are difficult to fund because the ratio of investment to return doesn't work. The proportionality doesn't work. We take all the money and be no benefit to the client. I mean, the situation there, of course, is that it costs the same to run a claim that's worth 10 million as it does to run a claim that's worth 1, 2, or 3 million. So that's why funding doesn't really work down at the bottom end of the market. But what we've had to do with these corporate clients and to try and persuade them to take our cash as opposed to using their own, even though, of course, financially and accounting it makes sense, is to provide a solution to help them ease that budgetary tension, that discussion between general counsel and CFO. And we do that by offering them a solution we don't cherry pick. We still have a right of refusal. We don't have to fund every case in the book, but they have to show us every case. So we make the decision. We still apply the same rigorous selection criteria. But the reality is what we're doing is we're saying to a corporate client, adjust the way you look at these things. Most corporate clients, particularly general counsel in Europe, are not litigators. They tend to be corporate counsel. And they consider litigation to be a problem, a liability, something they don't really want to look at. What we're trying to persuade them to do, and with some limited success so far and increasing numbers of success, is to get them to look at their disputes as an asset. There is no provision in general accounting principles for a contingent asset. So litigation or a dispute it's a strange process, defining it in that way. But what we're really saying is if you had a set of assets which can be monetized or securitized, but they have value, when you put a book of those claims together, it's no different. Well, the difference is, of course, I was going to say it's no different from a book of properties. The difference is our skill set is not as valuing property, it's valuing that contingent asset, which happens to be a dispute. And we can advance cash against those disputes for the purposes of whatever they wanted, what they want to do with it. Currently, the situation is that we advance money for the purposes of the budget for running those cases. When you're putting those cases together, as long as the value of the combined aggregate value of the claims in terms of the book of business is enough to allow us to invest the budget for the purposes of running each of those individual cases to conclusion, it allows them to take cases that have low value. It allows them to take cases that maybe be defense that have no value and put them into the same pot. Realistically, all we're doing is taking the aggregate value of the book and advancing a proportion of that to ensure that they run them to conclusion. So what we're doing is we're saying a number of different things. We're pointing out the accountancy benefits. We're pointing out the fact that we can provide a solution. At the same time, we're advancing in terms of our market out of the very competitive, not completely competitive, but much more competitive single case market, the limited pool of resources, into an area where there are no funders operating. So that, in a nutshell, is what the corporate portfolio market looks like.
And just by way of example, and this is the change in mindset, it's an example that we tend to use when we're pitching this product to large and sophisticated and well-capitalised corporates. which is 20 years ago, corporate entities utilised their capital account to buy their office furniture, their fleet of motor vehicles, perhaps their IT. And then with the advent of, and the accounting advantages of leasing, it's almost unheard of now for a corporate entity to actually buy those disposable types of assets other than through leasing and the accounting benefits for that. Now, what we're offering to corporates in respect of providing a funding solution in respect of their disputes is not a dissimilar concept to that. So what we would like to think over a period of time, in the same way that a corporate entity will think about who their leasing provider is when they're seeking to buy a new fleet of motor vehicles or office furniture or what have you, that corporate entities will start to look towards us as a provider of litigation finance products in respect to their disputes. So they'll start funding them, as a matter of course, off balance sheet. The second observation I'd make about this corporate portfolio market or this opportunity that we've got is it allows us, unlike single case funding, to invest much larger sums of money. So if you could understand that these portfolios of claims typically have a much larger capital commitment in terms of running those through to a conclusion. So from an investment standpoint, undertaking the same processes we do to underwrite each individual dispute, it allows us to make much larger and much safer investments because the risk is collaterally secured across all of those instead of having a binary outcome. So a very, very good product from our perspective. And if we look then at how much work a litigation financier has to put in to actually identify a single case investment as compared to a corporate portfolio transaction, the corporate portfolio transaction tends to be an enduring relationship with the corporate entity as opposed to a single one-off investment with an insolvency practitioner or someone who doesn't want to fund or can't fund their own piece of litigation. So it's got far more characteristics as an evergreen investment for us than a single case funding does. So it's an incredibly powerful tool for us on many levels to be moving into this part of the market. And the final point I'd make in respect of that is competition. Now, we've spoken about the statistics on this. So this part of the market where corporates are currently spending their own resources to fund their disputes is somewhere between 93 to 97% of the market. Now we are totally, at present, have no competition in that space. So some of the other funders are talking about these transactions, but they're not actually doing these transactions. We're actually out there doing them. So we've done 2 in the last 6 months. We're undertaking due diligence in respect of another 7 of those currently. And in certain pockets of industry sectors, such as building construction, oil and gas, aviation and what have you, we're getting really, really strong inquiries out of those. And you might ask yourself why these particular industries sort of resonate with this product more so than others. And that's because these industries tend to be high volume but low margin businesses. So the corrosive effect on their P&L is much more pronounced. So and that's why we're getting such good inquiry. And if you look at building construction, it's an industry which is not unfamiliar with disputes. So in respect of every building, construction or infrastructure project, there's inevitably disputes that arise out of that. So a really valuable tool for that industry sector. And the final observation I'd make in respect of competition is a very practical one, which is who of the other litigation financiers can address this market? Now, if you think about what we do, we undertake an assessment of the litigation risk inside a company. Now, there's only so many counterparties that are out there that a conservative manager of a large, well-capitalised corporation will permit to undertake that exercise in respect of its book. So most of the unlisted litigation financiers globally are backed by hedge funds. So if I look at where Nick came from, he was running a platform for one of the large and very activist American hedge funds. It's unlikely in the extreme that the manager of that business would allow access to its litigation risk inside there with that sort of a financial backer. So LCM is incredibly well placed, having the heritage that we've had being in this industry since the inception. So we've got a really strong and healthy track record. We've been in this industry for as long as the industry has actually existed. We've been listed on 2 public markets. So in a largely unregulated environment of litigation finance, we're the perfect sort of counterparty to be actually addressing this part of the market.
I just want to pursue 2 of the points that Patrick made there. You're very rarely going to have the same counterparty as a funder on more than one occasion because of the nature of the transaction. But you spend a lot of effort and you invest a lot of time and money in developing the relationship with that client for a one-off transaction. And the difference, of course, between single case funding and portfolio funding is one is one-off transactional, the other is effectively evergreen, because once a corporate client gets used to using an external source of capital and removes that corrosive effect of their EBITDA of paying monthly for legal spend, it's going to be very difficult for them to go back, change their mindset to going back to paying for it once they've had the benefit and seen the benefit of it. But more importantly is what I'd refer to as effectively the waterfall of influence in these situations. So in a single case, the usual methodology would be client goes to law firm goes to barrister and law firm go to experts, then you get a document management company and any disclosure, and then finally at some point in that process, somebody says, well, we've run out of money, we need a funder. And what happens is you come in last to the party as a legal services provider, a funder, and you're asked to quote on terms, and frankly, because there's three of you and they only want your money, they don't really want your influence or your assistance, they'll take your cash, but they want the cheapest. Not always, but often that's the case, because they're never going to use you again. So you think about where you sit as a funder in that transaction, and then compare and contrast that with where we sit in a corporate portfolio transaction. So you're sitting at the right hand of the CFO, GC, with the board. You're extending influence. You have a right of refusal on which cases get invested in, which cases they bring, the strategy, the law firm, who are you going to use. You're involved in all of those decisions. But instead of being right down here at last of the party, you're sitting right at the top, advising and assisting and deciding what cases that you're going to use. And of course, every case that comes up, you get to look at and decide. These are cases that aren't going to come onto the market, so they're a completely different situation. So from an ongoing investment basis, from a way in which you guaranteed continued referrals and cases, unless you do something really wrong, that's a much better situation to be in. That doesn't mean, of course, that single case funding doesn't have its place, because it really does. It's something that we do, something we continue to do, something that we get good returns on. So I'm not suggesting for 1 second there's anything wrong with it. But what I am saying is the blended portfolio or combination of those two different sets of investments is really important. And that's how you get scale. And that's how you continue with this business to operate in areas and with cases that other people aren't even seeing, because these are cases that aren't coming onto the market. We're generating them. So we're not taking market share, we're creating a new market. And I think that's quite an important point to make.
Can I just ask, how does the client account for the portfolio that he's farmed out some interest to you? It goes as an asset on the balance sheet.
Well, it's contingent, so it's not recognised on their balance sheet.
So it's not on there at all?
So they receive the revenue net of outlay, right, which we take. Yeah. So it's a positive. And effectively what you're doing there in that situation is you're creating a situation for a corporate client where historically their in-house legal team was a drain on resources and an expense. And they've suddenly gone from a cost centre to a profit centre, because what you've done is you're giving them the net return. Yeah. They don't have the legal spend, but the money comes back. Yeah. So you've completely turned the process around.
Okay. And then as one case out of 100 gets settled, then at that point they recognise the revenue?
Well, in effect, yes, the answer is yes. But of course, we get first dollar return or first pound. So in that situation, effectively, we're giving them a facility which is secured against the proceeds of all of the book. So they don't see any money until we've been paid off. Yeah. So once we've had our cash back and our return, then they'll start to recognise
cash back on the whole book.
Yeah.
So the loan's collateralised against the whole book.
Exactly.
Correct. And so it's
and that's where the price is a little bit lower, because our spread is much wider, which means the binary risk of single case funding is gone. And as Patrick said at the start, if you've only lost money on 10 cases and only had 5 adjudicated against you since 1998, if we're doing a 38 case portfolio in the aviation space, which we are, to get that wrong, we're going to have to do something pretty bad. And it would mean our underwriting process was flawed. And remember, of course, we're funding each of these cases having underwritten with the exact same principles.
Did I hear you say that you sometimes take defense cases?
Yeah.
In the board? How does that work economically?
Well, it's a benefit to us, but it's not a benefit to the client. The simple answer is this. Let's give you, say you have 10 cases that have a budget of £1 million each to run, and they're all worth £10 million. So you have a book of 100 million in value, and it's going to cost 10 million in budget to bring home that value if they all win. The client then says to you, I have a defense case and the budget's $1 million. I don't want you to pay the award if it loses, so we're not on the hook for the damages if they lose their case, but they need £1 million to run the claim. So if you put that into that portfolio, you then have 11 cases. You've still got 100 million in value. You've put another case in that's got no value, the defense, but the budget, instead of being 10 million, is 11 million. So we're advancing 11 million against a book of 100 million. All that's done for us is most of our returns in relation to corporate portfolios are a multiple of invested capital rising over time. So the advantage to us is we're taking more out of the cases that are there already, and we're allowing them to use the value in their book of business to finance the defense case. Now, there are two ways to do it. Either we could monetize part of the book to give them that £1 million to fund the defense case themselves, but frankly, I'd rather know what was going on. I want to see the bigger picture. I want to know what they're doing, what the strategy is, what's their theory, why they're defending it. So I'd rather put it in the portfolio and then I've got control and I can see it. It's got no value to me other than the fact that I'm getting a multiple on the budget that
Increases the size of your trade.
Yeah.
So your multiple is on the portfolio value rather than on a case-by-case basis.
Totally. And we tend
Dollars
to
invested.
It tends to be a one. So single case funding historically is usually done on a 1 to 10 basis. So every $1 million you put out, there's got to be 10 million coverage. In portfolios, we tend to work on a 1 to 4. So in that 100 million, there's probably the ability to advance 25 million. So if to run that book of 10 cases is only going to cost me 10 million, I've got headroom of 15. So I could actually run 15 defense cases in that same book. It's merely just looking at these things in a slightly different way. Nothing we do, careful how I say this, nothing we do is particularly clever. We just look at things in a different way in terms of looking at disputes as assets and asking clients to look at it in the same way.
But your multiple for company A with higher risk portfolio might be greater than for company B with a lower risk portfolio. Is that right?
Yeah, and that would be reflected in the pricing.
Yeah.
Yeah.
So this customer of yours, which has 38 cases that you've financed, they will not get paid any of the winnings of the cases till you've had the costs paid for all 38.
Correct.
Yeah. Okay.
Correct. And what happens in respect of these transactions is, give a building construction portfolio that has 7 different disputes in it. When the first one resolves itself, and on the assumption that there's sufficient capital there that's generated out of the resolution of that dispute to pay our investment and our profit back, we can then step out of that transaction completely, and the client can then determine whether it's going to use the balance of that money to fund the book. Alternatively, and what tends to happen with these transactions, because the corporate is now incredibly benefited by the fact that it's not corroding their profitability, they say, can we reset this portfolio? And what we're seeing in the building construction is they'll tip 1 or 2 new matters in and we just reformulate this portfolio. So from an investment profile for us, it's a very valuable relationship because it's perpetual.
Construction sector has been a really fertile hunting ground for us for a number of reasons. It's high volume, low margin. The margin in the English construction industry last year, I think, was negative 2%. So if you can take away legal spend, it's going to improve EBITDA reasonably well. The second part is they tend to be project-based. So at the end of every project, they move on to the next one, but there tends to be a construction issue, whether it be a final account or extension of time or some sort of variation. And the last thing within those is that once they start to use our finance and they like the ability that it's given them to take that spend out of that margin, particularly when it's tight, they have ongoing projects, which means they're constantly reviewing. So what we've found, it's certainly in the discussions we've had, is it's highly likely that once you've done one portfolio and it wins and you move on, they don't want to go back to traditional financing out of their P&L. They want to put in another case and reset the portfolio. So the phrase we've used is evergreen, but the reality is they're just perpetual investments.
Well, yeah, if it's worthwhile in the first cases, it'll be worthwhile later.
So,
Yeah. And one of the other features of this, obviously, is that these investments, from our perspective, are not as attended with the same risk, the same binary risk as a single case investment, because we're collaterally securing our investment across 7 disputes. So our prospect of capital loss is very significantly reduced.
So what's the effect, what's the margin on these portfolios, if you can say that?
Yeah, look, I'd say publicly what they are, and we have done regularly. Single case funding, everybody talks about 3 times or 30%, so a 4 times return or 4 times multiple. I don't think I've ever done that deal in 10 years of doing this because it tends to be much more complicated than that. Single case funding is expensive, but portfolio financing, as you said, you have to compress the price, otherwise the corporate client is going to use their own cash because the cost of capital is going to be too high. Where we get to is corporate portfolios tend to start, and I'll explain what I mean by this, because they demonstrate different characteristics. Pricing usually starts at a 0.25 multiple. So for every £1 million that we put out, we get 250,000 back plus our million, so 1.25. But remember, that starts, and again, it tends to be on an increasing multiple over duration. So for the first 6 months, we might charge 0.25. It's unlikely that we're going to get any resolutions in the first 6 months. But I'll come back to that because there's an important distinction between portfolio and single case. It tends to cap out at 1.5 after, say, 18 months. So our return is money back plus 1.5. We aim for 100% return. So for every $1 million we put out, we expect that $1 million back plus $1 million in profit. They're still really good returns. It's still non-recourse lending, of course, if it is lending, advancing, investing. And we're only the client's only on the hook to the extent that there are proceeds of the book in the portfolio. They're not going to pay us back unless that set of cases produces revenue. The important thing to remember about portfolios is it's very unusual that you will get a set of cases that all have the same characteristics and duration, because in a portfolio, you're asking a client to give you the sets of proceedings. So some of them might be a year old, some of them could be 2 years old, you won't have an appeal, there might be a judgment. So what you have is a much smoother set of returns. Instead of the lumpiness that we get in single case funding, these throw off cash more quickly and it should come back more quickly. The reality is we aim for the 100% return. The blend is going to be about that, but they demonstrate different characteristics, obviously.
You mentioned that in the former model, the client would have to recognise the income as exceptional. I still can't quite get my head around here. When eventually they start getting a return from the portfolio, where does that income go?
Probably the same way, but of course they don't have the deficit, the outlay. So it still proceeds from litigation. So I think it would still be an exceptional item.
Can I come back to how this affects your P&L rather than clients for a second?
Sure.
Can I see if I understand this right? Revenues on your P&L are successful cases where you get
Concluded.
your percentage of the successful cases, full stop.
Yeah.
Right.
Gross profit is then successful cases less unsuccessful cases, or are there other costs in there as well?
No, it's typically that.
Typically that,
Yep.
okay.
Yep.
And then the rest of your expenditure is what gets taken off to get you
Yeah.
profit. Okay,
Yeah.
got it.
So incredibly
So you've
simple.
had successful cases, revenue value 34 million last year.
Yeah.
Great.
Yeah. So I want to touch on two really quick points before we move off. So we've talked about corporate portfolios as being one of our strategies moving forward. But I just want to talk about how we think about our book of investments of single case funding and our corporate portfolios. Now, we actively manage our investments to keep them balanced in the same way that any other investment manager might manage their investments. So we want diversity across that book. We don't want that book to suffer from concentration risk in respect of any single investment, so in terms of capital commitment. So we manage it in that way. And we manage it against industry sectors. So we're not a funder who does entirely international arbitration, for example, and we don't do entirely insolvency matters. So we have a spread across the entire spectrum of investments, and we think that's a really important balancing exercise, and it's something that we maintain and strive to achieve. And if you look at slide 17, which is our pipeline of opportunities, or certainly was our pipeline of opportunities when we did our announcement of our full year results, you'll see there that it's exhibiting the same sort of balance in terms of the opportunities we're seeing. So what I'm emphasising there is we're getting this natural balancing process through our pipeline of opportunities. And the last observation I want to make in terms of the opportunities which present to us. So very much we are looking at corporate portfolios as an opportunity. We're heavily and highly focused upon expanding into that market. But right at the very other end of our business model is a product that we have started trialling. So I think we're 4 months into a trial of this. And this is acquisition of small insolvency-based claims, which we acquire as principal. So we looked at the skill set inside LCM and looked at how we might leverage off that skill set and supplement our revenue line and try and bring some smoothing effect into our revenue line. And what we recognised was that LCM had this tremendous experience in insolvency and restructuring financing. We'd been there since day one in respect of this industry. We'd been funding matters and selecting the appropriate investments in insolvency for 21 years. We're very, very good at it. And we looked at what proportion of our book was currently insolvency matters, and it was very small. And that was simply a direct reflection of the fact that we've had so many years of buoyant economic times. And that part of our business is very counter-cyclical. So what we then focused on was some changes, legislative changes, which have been brought in the markets in which we operate. So I'm talking about the UK market and the Australian market, and more recently in the Singapore market. So legislation changed to permit insolvency practitioners to sell their statutory rights off to funders or whoever might want to buy them. So what we're doing is we're stepping in there. They tend to be smaller claims. We're stepping in there as principal. So we're actually acquiring causes of action from insolvency practitioners. So what that gives us is it gives us a hell of a lot more control over those investments. So whereas when we're funding, the principal is not us. The funded party makes the majority of those decisions with our assistance and what have you. But when we're looking at this model, we're very much drawing upon the skill and experience we've got in insolvency and we've had over these years. We're acquiring these claims and we're prosecuting them ourselves, and we have utter control as to when they settle and for what amount. So we've been going now for 4 months in respect of that in the UK and the Australian markets, and that particular business model seems to be exhibiting the following characteristics. So they tend to be smaller investment opportunities for us. So we're buying these opportunities at somewhere between sort of 5 and 10 cents in the dollar. And we expect that the financial performance of these investments will be at least commensurate, if not better, than what our track record has been, because we've got more control of them. The risk profile tends to be better for us because we're in complete control. So we don't have the risk associated with someone being uncommercial or what have you, because we've got complete control over that. And we're expecting to see the time for completion to be brought down as well. So it should be incredibly additive to our revenue line, this type of product. So we're expecting, and we're going to be focused on this in the coming years.
How quickly would you imagine to see a material effect on revenues from this new?
Look, I think probably we need to build into this, and once we've probably been doing it for a couple of years, we should see some sort of material impact upon our revenue line from that source.
Have you got a time frame for when you're likely to adopt the proportion of fair value accounting?
Look, there's a whole series of factors which are at play associated with that. The short answer is that as our business grows here in the Northern Hemisphere, it's going to probably put more and more pressure on us to adopt some form of fair value accounting compared to where our revenue was originally generated, which was in the Southern Hemisphere and typically in the Australian jurisdiction. And
is that going to suddenly lead to a cliff edge, at which point you're suddenly going to get a big plus on your P&L because you're in that period recognising big sums?
The answer to that is no, I would suggest. And the reason for that is if we find ourselves in a situation where we need to adopt fair value accounting, consistent with historically how we've accounted in a very conservative fashion, we'll adopt a valuation principle associated with these level 3 assets or these investments that we make in a very, very conservative fashion. So investors should not expect us to be fair valuing these assets in an aggressive or racy fashion. We'll be very conservative, we're very transparent, and we'll make all that information on how we undertake that valuation process available to the market.
Patrick, Nick, thank you very much indeed.